Hello and welcome to the DIY Investing YouTube channel. We are running through every stock in the S&P 500 doing a 5-minute stock analysis. And today is Charter Communications, ticker CHTR. We are using the Quick FS tool to do a quick analysis on the company. The next 5 minutes you'll learn what I think about Charter as I run through this business. This is my first 5 minutes of due diligence. So immediately we see this as a media company. Now this company was specifically requested by a listener, and so you're going to get a little bit of a different look than normal today as I go through. So Charter Communications provides broadband connectivity and cable operator to residential and commercial customers. So this provides internet service, security suite, spyware, in-home Wi-Fi, and video service. So basically we're talking about internet, fiber, video, which is basically cable channels, to U.S. customers. They have 31 million customers across 41 states, and it's headquartered in Connecticut. So the beta is 0.96, nothing remarkable, can't really learn anything there. Share turnover of 192%. Tells me there's not a strong shareholder base here, so maybe it doesn't have, there's a lot of turnover in that business. So this is a cable company, internet company, so some of these numbers are going to be a little different from other types of companies. One of the things you immediately need to know about when you look at cable companies is judging them by earnings is going to give a poor result. And so we can quickly see this when we look on a return on invested capital. Return on invested capital is earnings divided by invested capital. So if you don't have earnings, the numbers are going to look bad. And so they basically had negative earnings all the way until 2015. And so in 2016, they started showing a profit. 2017, profit, 18. So basically, they've only been profitable since 2016. This is not a good record because their return on invested capital never exceeds 10%. The most recent year in 2021 had a return on invested capital of 3.99%. So really bad numbers. If this was all I knew about the company, I would not invest. However, I know that cable and internet companies are not generally judged on earnings. I judge companies on earnings, but you need to be skeptical here. So we're going to try and do a little bit deeper analysis today. It might be a little longer than 5 minutes to kind of help you understand what's going on here. Let's look at 10-year median returns. Return on assets, 1%. Return on equity, 3%. Return on invested capital, 1.2%. These are really bad numbers. Again, you want these numbers to be above 10%. You need double digits, 10, 15, 20% to really be successful. The whole way this business works is really building lots of assets, leveraging up, and having long-term cash flows. But your return on equity then should still be high. But again, there's a lot of debt and leverage here. The PE is 22.7. So bulls will say that understates the value of this company. Because it's about cash flow, not earnings. And you're going to see this with these higher numbers. EV to free cash flow is 22.5, EV to EBITDA, really high numbers. It doesn't look cheap here. 10-year CAGR is important. So what you're seeing, actually, this is a good number here to look at. So you have your 10-year median margins. Pre-tax income is 2.6%, but free cash flow is 5.7%. So basically this business is going to have double the free cash flow of their income, which means you basically would argue that, okay, well, maybe the PE ratio on a free cash flow basis is like 11. And so that's where it kind of looks a little different. Now, normally if revenue is growing at 20% and assets are growing at 25%, that's a bad sign. You don't want assets to grow faster than revenue. However, over the last 10 years, free cash flow has apparently grown at 38%. And so that's really the positive bull case on this company, is that they're trying to judge themselves on free cash flow. And so they're growing free cash flow quickly, and they're growing free cash flow faster than assets. Normally, if you grow assets this fast, it's a really bad sign. So revenue's grown from 7.5 billion to 51 billion. This is a huge company. And we're showing in the very most recent year, you might have a return on equity here of 19.2%. So you're finally starting to show something positive. If we go to the income statement, you're going to see the issue here that your gross profit gets up to about 20 billion. Operating profit, 10 billion. Pre-tax income, 6 billion. Net income is 4 billion. The problem is this company is so big. It's a $105 billion market cap and $193 billion EV. So when we go to balance sheet, we're going to see a lot of debt. And let's see, long-term debt has grown from 12.8 billion to $88 billion. And so there's a huge amount of debt on this business. $88 billion in debt against what did we say the earnings were? So versus $4.6 billion in earnings. So your debt is 20 times earnings. This is a really bad setup. It's extremely leveraged. This system only works with low interest rates. We have low interest rates. So it's really driven by that. You'd have to do a deeper analysis to see how those interest rates stack up. What are the repayment schedules? With that said, internet service, fiber service, cable service is a very sticky business. It's a very good business to be in because while what they're doing is they're investing in assets. So you see their PP&E goes from 7 billion to 34 billion. And they've also have a lot of goodwill because they made a big purchase here. You can see goodwill and intangible assets go up from 2015 to 2016. So there's a big acquisition taking place here. You can see that growth. And you're going to probably see, debt goes up significantly in that year as well. You don't have any retained earnings. That's because they're not earning money. And shareholder equity is crashing. So they're probably doing something weird with cash flow. Okay, this whole business is about cash flow. Like it or not, cash flow from operations is positive every year. Finally, we see something positive from this business. If this number had any negatives, you'd be scared, but it's continuously going up. That's a good sign. But they're constantly reinvesting that money in PP&E, and you can see that they're issuing common stock. Or no, net issuance of common stock is negative, so they're buying back stock, and net issuance of debt is positive. So basically they're issuing debt to buy back stock. It's a lot of funny business on the financing, and they're constantly taking out new money. So if you look at it, cash from operations, and we just assume this is the real number, and you say, okay, cash from operations is 16 billion, and this is a $105 billion market cap. Well, now you're like 6 times free cash flow is the market cap, but you're about 13 times free cash flow EV. That's where, okay, well, maybe this company's attractive, but is that cash flow real? Why is this cash flow not converting into earnings? And so it's because you have a lot of depreciation. And so this depreciation number of $9 billion is the difference. So you have to know when you're evaluating this company, is the depreciation a real expense? It almost always is. Are they going to have to spend this money later to do repairs? If they're laying fiber lines, do those fiber lines need to be repaired? So I don't like cable and internet companies because they don't show earnings. And accounting earnings are important because they protect you from making mistakes. Most people love these assets because the free cash flow is amazing. But if you just look on a first basis, if you just do this 5-minute, which now 8-minute review, it doesn't look great to me, but there's promising things. It could be cheap if you only look at this free cash flow, you trust the management and how it's being managed, but it's dangerous. Your earnings are $5 million. You're never going to be able to pay down this debt unless you stop growing. And if you stop growing, I have a feeling the stock crashes. Thank you for listening. If you found value in this, hit that subscribe button, click the like button, and follow up for the next video in the S&P 500 series. Thank you.